Today I'll be looking at the 5 tax strategies rich people use that poor people don't. Now, one of the biggest differences between wealthy and average business owners isn't just how much they make, it's how they structure their finances to legally minimize their tax burden. Over my years of working with high net worth clients, I've seen consistent patterns in how wealthy people approach taxes that most others completely overlook. And that's exactly why I'm making this video today, to reveal the tax strategies that wealthy people use to keep more of their money, strategies that anyone can implement. So let's get right into it. The first strategy I want to talk about is just this concept of understanding government incentives when it comes to business owners. And this is what we talk about a lot, where we talk about this concept or idea of maximizing deductions. So how do I turn after-tax spending that I'm going to do no matter what, into pre-tax spending? And so the biggest concept I can give to this, and this is the benefit of being a business owner, that the government gives you this benefit. They give you these opportunities for tax deductions, and it's just understanding that. But the concept that I often give is this idea of, I'm a W-2 worker, I have gross wages, my employer takes all these taxes out of my paycheck, and then whatever's left over is my take-home pay. And that's all considered, that take-home pay is money that's already all been taxed. And so if I go out and buy for my W-2 job, working out of a home office, I have a desk, I have a microphone, I have computer screens, all those different things, I get no tax deduction for that. I use that take-home pay money that I received and buy it, and I get no tax deduction for it. But let's flip the switch. Let's look at this as if I am a business owner. As a business owner, we get our sales or our revenue inside of our business, and then we have all these expenses that go after it, and then whatever's left over is our profit, and that's what we get taxed on. So that desk, that microphone, that computer screen, that camera, that computer, all those different items that I bought as a business owner, that home office that I'm now working on, I get a tax deduction for that. And so what I see so often with rich clients is understanding this concept and saying, how do I take spending that I'm going to do whether I'm a business owner or not, but how do I take that spending, find a business purpose for it, and move it from after-tax spending into pre-tax spending? And so let's look at some concepts of this. Let's look at automobile. Look, whether you're a business owner or not, you're going to have an automobile. That we know. But now as a business owner, you have the opportunity to get a tax deduction for the business use of that automobile. That's a great opportunity. We look at meals, having meal expenses. This is a great opportunity to find business purpose to meals that you're doing. Now, you might be meeting with a friend, but as you're meeting with a friend, you're talking about your business. You're asking for referrals. That's a business conversation that you're having, looking to take advantage of those opportunities. Maybe travel. I see a lot of wealthy people do this, where they plan travel that they want to do anyways, but they plan business items around that travel. Maybe they're meeting a client, maybe a vendor, maybe attending a conference, all these different things in travel that they want to do, but now they're just finding a business purpose to wrap into that, at least part of that trip deductible. Again, we talked about technology in the beginning. This microphone I'm talking to, the camera I'm looking into, computer screens, devices, cords, all these different things are all valid business deductions. And then the government says, okay, we want people to be business owners. Why? Because business owners hire people, they help grow our economy. That's something that we want. A thriving country has a lot of business owners inside of it. And so they give you as a business owner incentives to become a business owner. And that is this idea of moving after-tax spending into pre-tax spending. So we can look at other strategies like the home office deduction, or maybe hiring your kids in your business and getting a business deduction. Your kids potentially pay no taxes on that. Or maybe setting up a board and maybe using the 14-day home rental rule or the Augusta rule, contributing to your retirement account, implementing an accountable plan. There are so many different opportunities out there that I see the rich people looking into this, learning about this. And so how do they implement this? How do they know about these different things? Well, this stuff is in the code. This is not, some type of hidden gem or anything like that. This information is out there, and we talk about it every week. We talk about it every week on our podcast. We talk about it every week on our YouTube channel. We talk about these opportunities all the time. And so what the rich do is they learn these strategies. They learn the strategies that are available to them, but they don't just stop there. After they learn the strategies, they implement them. And more importantly, they correctly implement them. Because every one of these strategies is written in the IRS code. It's allowed, but you got to do it correctly. You can't abuse the system, because you can take something that is completely legal and make it illegal simply by not implementing that strategy correctly. And so that's the steps. Learn strategies, learn what's available to you, and then correctly implement those strategies in your business, and you'll start to see tax savings. Now, this is just kind of one example. This concept of maximizing deductions, items we talked about, are just an example of over 70 plus write-offs available to business owners. And I, unfortunately, don't have enough time to cover all those deductions that are available to you in this short video. However, if you want to learn more completely for free, click the link in the description to get access to a free document with over 70 plus different write-off opportunities, examples of how to use them and who they apply to. Click the link in the description and we can go over that. So that was strategy number one that we see the rich do, is understanding this government incentive that the government wants people to be business owners. And as part of that, they incentivize us. They give us this opportunity for deductions to offset that business income. Now, strategy number two is entity structuring. And this is just correctly thinking about the structuring of your entity. So do you have a foundation for your business? If you're a business owner, do we have a foundation? Do you have an LLC set up or maybe a corporation set up? Do we have that foundation set? Because that is the starting point. Anything that you build with your business, you're going to build off of that foundation. And we see the rich people set up these foundations right from the beginning. They spend some time to make sure, do I have everything correct as I'm getting started as a business owner? And let's build that foundation so that when we grow and we grow even further and we grow, add more businesses, and now we look to sell businesses and then we buy more. Do we have a foundation that is set up to handle that growth and to handle the tax pieces of that? We also see as part of entity structure is a time where people shift and say, I think I need to become an S corporation, or I at least need to start looking into an S corporation. An S corporation is something we talk about a lot, but it's a way to help minimize the amount that you pay in self-employment taxes. So it's just one strategy in the tool belt. You need to have that foundation first, but then when the time is right to move to an S corporation, you have that ability to go to that. And you as a business owner, if you're making $50,000 or more in profit, even you can utilize an S corporation. This isn't just reserved for the wealthy. We see the wealthy use it more often than not because they're aware of these opportunities that are out there, but it's available to you too. The next thing we see the wealthy implement is multi-business structuring and making sure that they have that set up correctly. So when we look at this idea of an S corporation, the benefits of an S corporation is to help minimize the amount that we pay in self-employment taxes. But what happens when we have multiple businesses? So maybe we have a consulting arm and then we start a software and then we have this other business and then we have this other business. Now we have 4 businesses that we're actively kind of running. How do we structure that? What does that foundation look like now that we have multiple businesses? Do we have an S corporation for every single one? And that's not the case. So what we typically see wealthy individuals do is they have one main company. They have one what I call a holding company or a main company. And that main company is going to handle all of their active businesses. So if they have a passive activity or a real estate property or something like that that they're not active in, we don't worry about that. But they have one holding company that holds their ownership in all of their active businesses. And that holding company is going to be what they own 100% of. And that holding company is going to be an S corporation. And if they have a consulting business, that might be a separate LLC, that's going to be 100% owned by that holding company, that S corporation. And then maybe had the software. And maybe they own 50% of it or 20% of it or 100%, but whatever their ownership percentage is in that entity is going to be owned by their holding company, their S corporation. And that other business that they have that they're active in, same thing, their ownership percentage is going to be held in that S corporation. And the reason for this is that now you have all of this active business income flowing through to one final return before going to them as the owner of these entities. And that can be a really nice structure to work with. They might even see, we see some wealthy clients as they set up a C corporation as a management company. So they'll have maybe this holding company, but then they'll use a C corporation as a management company to help take advantage of some strategies that maybe aren't available in an S corporation. So there's a lot of different entity structure planning that we see a lot of wealthy individuals work with, but it's the same type of things that we want you to be doing regardless of where your income is, whether you're making $10,000, $50,000, $60,000, $100,000, $500,000 a year, $5 million a year. This is the same type of structure that we can be implementing regardless of where you are in that spectrum. Again, we just need to learn it and then correctly implement those strategies. Now, I just want to vent for a little bit. So first off, uber wealthy individuals have a team of lawyers, accountants, and just a whole group that helps them navigate this idea of how do I pay the least amount of taxes legally possible? And those are things that obviously your everyday business owner, they can't afford that. And that's where my passion stems from. How do I bring these same strategies and thoughts that people with teams that handle this for them can do? How do I bring that process and ideas and strategies to everyday business owners? And this, along with all the other work we do here in TaxHelm, is really meant to complete that goal. Finding ways to bring the strategies that the rich use to individuals regardless of your size. Bring that opportunity so that any business owner in the US can pay the least amount of taxes legally possible. And that's really my passion and what we do. All right, so that was strategy number 2, entity structuring. Strategy number 3 is real estate. Now, you're working with a lot of kind of high net worth individuals. Real estate is one of the key things that we see more and more people getting into. And why are they getting into real estate? Well, there's a few things. You have depreciation, cost seg studies, real estate professional, all sorts of different things. But why can real estate be so attractive? Number 1, government incentive. Remember, let's go back. The government wants people to be business owners, so what do? They incentivize you. They allow you to turn after-tax spending into pre-tax spending and offset your income with it. The government wants people to invest in real estate. Why do they want you to invest in real estate? Because it brings housing. It brings opportunities available to high, low, middle, wherever your income level is. It brings housing opportunities, which can really be good for our country. And so the government wants that. The government wants people investing into real estate. How do they incentivize you? They incentivize you by the use of depreciation. And depreciation is really an expense that you can use to offset your income from that rental property. Now, let's say you buy a rental property, you get some loan on it, whatever amount it is. You're going to take all those expenses that cost to operate that rental property. So the utilities, the mortgage interest, the repairs, maintenance, the upkeep of it, all those different things. You get to obviously expense those items, but then the IRS gives you a nice little treat on top of that. They give you this idea of depreciation. And depreciation is where we take the cost of that property and we get an expense of it over time. And that's this idea of depreciation. Now, depreciation is an expense that offsets our income, but we're not actually paying any money for that depreciation. So if I get this year, I buy a rental property and I get $10,000, just a basic example, in depreciation, I didn't spend $10,000. So that money didn't actually go, but I still got that depreciation deduction based on the value and the cost of that property. Now, the government also allows something called a cost segregation study. And this is where you have the ability to take that depreciation that the government gives you, but accelerate it by taking a lot of it in year 1, maybe year 1, 2, 3, 4, 5. We're taking that depreciation that's typically spread out over 27 and a half years or 39 years and accelerating it and taking it all up front. And so what does that mean? That means that oftentimes we can buy, say, a $500,000 rental property and get a large expense on that in year 1. And that means that rental property is going to be producing a loss, especially in year 1. And what can we do with that loss? We can use that loss to offset other passive income. So if we have rental properties that are cash flowing, depreciation is not much left, and we're seeing income from it, well, we can buy a rental property over here, take the depreciation from that rental property, the loss from that rental property by accelerating depreciation through the form of a cost segregation study, and utilize that to offset our other passive income. Now, another cool thing is that if you can qualify as a real estate professional, now you can use those real estate losses to offset ordinary income. That's W-2 income, business income. And whether it's you that qualifies as a real estate professional or your spouse, you can offset all of your income. And that is a really cool and unique tool that real estate can give. And so we see a lot of wealthy people getting into real estate. But it's not just reserved for the wealthy people. Whether you're making $100,000 a year, $50,000 a year, you can utilize these same tools to do it. Now, your scale might be a little different. Instead of buying a $6 million apartment complex, maybe you're buying a $100,000 single-family rental property right down the road from you. But either way, we can utilize these same tools that the wealthy are utilizing. Something called depreciation, something called a cost segregation study to accelerate depreciation, something called a real estate professional status, where we can qualify as a real estate professional and then utilize losses from real estate to offset W-2 income, to offset business income. This is a great opportunity. So that's strategy number 3, investing in real estate. Strategy number 4 is tax-advantaged investments. And so we're going to talk about a few different types of tax-advantaged investments that we talk about, that we see the wealthy specifically utilize. One is, as an example, solar investment. If you invest in solar projects, you get depreciation from those solar projects that you're investing in, along with solar tax credits. And those can provide massive year 1 savings while also continuing a stream of income down the road. Now, a lot of times we talk about some of these tax advantage investments, we have to qualify as a material participation. Basically, the IRS says there's a bunch of tests you have to make. As long as you materially participate, which is relatively easy to do, it takes some time, it takes a good amount of hours to be able to put in, but if you can qualify, you can materially participate, then you have the opportunity to create massive deductions in year 1 or tax credits in the solar example that can offset to income, that can offset business income. Other people might look to oil and gas investments. And then with oil and gas, you have deductions that you can take in year 1 or year 2. That's intangible drilling costs, tangible drilling costs, depreciation, all those different items that you can take as a deduction which may create a loss. There's also growth in oil and gas, and that's growth is not 100% tax. There's something called a depletion allowance, where you're not paying tax on 100% of the income that investment is producing. So oil and gas can be another tax advantage strategy that people use to offset the business income that they're producing, to offset the W-2 income that they're producing. Then we also see people invest in Section 179 projects or depreciation projects. Some of the ones that we've seen are equipment or maybe software packages that they invest in or start, an LLC to manage this investment in equipment that they're buying, or maybe a software package that they're buying, and then they rent out those pieces or lease them out to other people. This offers a potential to get a large upfront deduction in year one due to depreciation or Section 179 expenses. But then there's also future income from those types of projects. So these are all different types of investments, tax-advantaged investments that we see the wealthy invest in that create losses or create tax credits that would not be available in their normal course of business, that they can utilize those losses or credits to offset their income from other sources, like their W-2 or their business income or whatever it might be. Now, the goal with all of these kind of tax advantage strategies is to front load deductions in the beginning years to offset income, bringing their total taxable income down, leading to them paying less taxes. Now, these strategies can be available to people of all different sizes. Now, if we look at solar or oil and gas and some of these projects, you have to be what they call an accredited investor in order to get into these types of products, which means that you have to be more in the higher income range. But we can take this same concept and utilize it at different stages. Let's say you're an electrician and you are just getting started, you're making about $50,000 a year, but now you need a new van. You've been working out of your truck, but now you want a business vehicle to really help grow your business. Well, we could potentially use Section 179 or some type of depreciation, purchase a vehicle that could potentially offset a good portion of your income, that $50,000 of income you did. So it's taking that same concept, but bring it down to your scale. Others might be in that place where they can invest in solar, can invest in oil and gas, or can invest in Section 179 projects outside of their business. And we just need to analyze that to see if it makes sense to you. Now, a key point that I kind of want to make on this topic is that the rich utilize certain investment vehicles or strategies in this realm that not only provide tax savings, but also lead to more growth and wealth over and above the tax savings side. So they look at these projects and say, I want to invest in this, not just for the tax savings. That's a beautiful advantage, but there's also an upside for that. If we look at the solar investment, you get a big upside deduction, but there's also future income. If we look at oil and gas, you get a very nice tax benefit. Why? Because the government wants us drilling. So they give a nice benefit for investing in oil and gas. But you also have a lot of growth that can come from that and a really good investment return that's potential with that. If we look at investing in equipment and then leasing it out, or investing in software packages and then leasing it out, you get a great potential upfront deduction, but now you have future income down the road. So these tools not only provide great tax benefits in year one or in early years, but they also produce significant growth, which adds to more wealth. And that's why you always say the rich get richer. Why is that? It's because they're saving taxes and they're using that money that they save in tax savings to invest even further, to grow their wealth. And not only that, the investments that they're making often are tax advantaged, where they get tax savings benefit, plus they're going to have future growth from those investments. It's a win-win situation that regardless of your size, you can do a form of this. Maybe it's not the exact same strategy. Maybe it's not to the extent that the rich are doing it, but regardless of where you are, you have the opportunity to take advantage of these types of things. Now let's finally look at strategy 5. This is strategic charitable giving. And there's a lot of different routes that people can go down here. We see rich people often form foundations, and you'll see, the Bill and Melinda Gates Foundation and various different foundations that you see really wealthy people have. And this is basically an opportunity to get a charitable deduction without having to distribute those funds right away. Let's say you have a certain charity that you want to support, or a certain concept that you want to be charitable to. You don't necessarily have to say on December 31st, all of it's going to that charity. No, we can start a foundation. And with that foundation, we can get the charitable deduction that we want, but then we can distribute those funds as we see and when we see fit. Now, there's some requirements and a lot of things you have to follow, and there's a lot of setup here. But typically we're seeing, people with $1 million plus in charitable giving, they start to go down and look into this foundation route. There might be this concept of charitable trusts, and these are kind of potential vehicles that you could use to avoid capital gain taxes on the sale of a highly appreciated assets while still taking care of a charity that you want, as well as your family, for those gains from that sale. We also see people do a leveraged charitable giving strategy. So, we see people a lot of times they're very wealthy. They want to support their church or some other charity, And instead of giving that church or other charity cash, they might give them appreciated stock. So they might give them a stock that has a big gain in it, and that they donate that stock to the charity. That charity sells it, doesn't pay taxes on that gain that's in there. So it's an opportunity to say, instead of taking that charitable giving, cashing it out, paying taxes on it, and then giving the cash away, let's give the stock away. And so that's an opportunity that can be available to people of all different sizes, wherever you are. So some of these options, when we talk about charitable giving, whether it's foundation or charitable trust, they have high costs and really kind of complex structures on them. So they might not be available to those until you're making enough money to make it make sense. Or it might not, the costs and maintenance of them might not make sense if you're just looking to contribute $5,000 a year to charity. But guess what? As you continue to grow, they might open up the door for it. We've also seen people that make a modest income. They wouldn't call themselves uber wealthy or anything like that, but then they have a sale of a business down the road. Or maybe they have crypto they invested in has a huge gain. Then they can start to look into, in those sale years and those exit years, they can look into maybe a charitable remainder trust, a CRT, a CROT, different types of trusts that can help minimize the amount of taxes that they pay on that sale. And again, one of the most strategies that we see, everyday business owners utilize is the leveraged charitable giving. Again, as an example, let's say you bought a stock for $5,000 and now that stock is worth $10,000. And let's say that you want to give a charity or your church $10,000. So instead of cashing out that stock that's worth $10,000, you're going to pay capital gain taxes on the gain of that, which is $5,000 gain that you're paying capital gain taxes on. And then you go to contribute that funds, you can't contribute 10 anymore because you had taxes on it. So now you may be looking at contributing 8,000 instead of 10,000. However, if instead of going through that whole selling this asset, taking the cash, paying the taxes, and then giving it away, what if we just gave that asset to the charitable organization and they sold it in a tax-exempt state? So that stock that we bought for $5 is now worth $10. If we take that stock and give it to charity, we're getting a $10,000 charitable deduction, and then the church or charitable organization sells it, they're paying no taxes on that. So this is an opportunity that people of all different levels can take advantage of. And so when we talk about these different strategies, strategy 1 was understanding government incentives for business owners. Strategy 2 was entity structuring, having that solid foundation and making that choice to S Corp and right, and what happens when you have multiple businesses. And then strategy 3 was investing in real estate and taking advantage of cost segregation studies and depreciation. And then strategy 4 was tax advantage investments and how do we leverage that into our business structure. And then finally, strategic charitable giving. We look at all these strategies that the rich utilize, and honestly, as we kind of talked about today, they're available to people of all sizes, including you. If you're just your average American, you don't consider yourself in that wealthy bracket, these strategies can be available to you, maybe not to the extent that the rich or the wealthy utilize them, but oftentimes some form or version of these strategies are available to people of all different sizes. So now that you know the tax strategies that separate wealthy retirees from everyone else, you need to understand one thing. These tax moves are just part of the wealth building equation. You can't walk away from this video thinking these strategies alone will make you rich. Through the hundreds of people I've helped with their tax plans, I've seen firsthand the negative effects that occur when people think these strategies alone will make them rich, when in reality, they are small pieces of the puzzle for building your dream financial future. There's so much more that goes into building real wealth. If you want to find out more about how to get help with this, click the link below in the description to get access to unlimited consultations with our team of tax experts. I'll see you on the next one.